Welcome to the Deep Dive, the show built for you, the curious learner, where we take a stack of sources, cut through the noise, and extract the most important nuggets of knowledge or insight.
Glad to be diving in.
Today, we're plunging headfirst into, well, a really high-stakes clash that's just dominating the economic headlines right
Yeah,
now.
I think it's everywhere.
President Trump's direct and very, very public challenge to Federal Reserve Chair Jerome Powell. And look, this isn't just another political spat, this is about the fundamental levers of the U.S. economy.
It really is. It touches on the very independence of one of our most critical institutions.
Exactly. And ultimately, what it means for your wallet and, well, your future.
Indeed. What's fascinating here, I think, is that we're seeing just an unprecedented level of public pressure on the central bank.
Right.
It's pushing not just for specific policy outcomes like rate cuts, but it's also questioning its operational management, how it runs itself.
The renovation thing, yeah.
Exactly. And if we connect this to the bigger picture, it really highlights this inherent tension, doesn't it, between political will and institutional autonomy.
Yeah.
So our mission today is really to unpack these complex layers for you. We want to understand the specific points of contention, like what are the exact accusations? What's the factual basis behind them? And then explore the broader implications, for the economy, for financial markets,
Yeah.
and yes, directly for your everyday life.
Exactly. We're going to filter through all the rhetoric, try and get to the core of what's truly at stake here.
Yeah.
What are President Trump's core grievances against Powell? What are the Fed's defenses, their justifications for what they're doing?
And importantly, the why behind those defenses.
Right. And as always, what does this all mean? The big picture, the global economy, and, like you said, your daily life.
So to do this, we've pulled from a really diverse stack of sources,
Yeah.
Detailed news reports from major outlets like Reuters, Fox News, in-depth expert analysis from financial news leaders like investing.com, and even insights from real estate data on realtor.com.
So a good mix.
A really good mix. We're talking direct quotes from the key players, expert opinions from, seasoned financial institutions, economists weighing in from various perspectives.
Our goal for you is to extract the most important nuggets of knowledge from all these viewpoints, deliver them straight to you.
Right, so you can be truly well-informed without having to, wade through dozens of articles yourself.
Precisely. Okay, let's unpack this.
Let's do it.
So let's kick things off with the most immediate battleground, right? The one that really ignited this latest round of public sparring.
Monetary policy.
Monetary policy, exactly. Specifically, interest rates, and the president's rather pointed accusation that Powell is too late.
That nickname.
Yeah. This has been a recurring theme, hasn't it, throughout his past presidency and now into his current public commentary. But it seems to have reached a new intensity this past Tuesday, August 12th, 2025.
That's right. President Trump's core complaint, and he articulated this recently via a series of Truth Social posts, is his repeated, very insistent call for an immediate interest rate reduction.
Not just a reduction, but immediate.
Immediate. He's been remarkably vocal about this. It's become a central point of his economic commentary and, frankly, a key promise for what he'd do if he were to regain office.
And his argument is?
He argues that high interest rates are acting as this unnecessary drag on the economy, basically preventing it from reaching its, full potential.
Okay. And he didn't just stop at calling for cuts, did he? He launched a pretty personal attack on Powell himself.
Yeah, dubbing him Jerome Too Late Powell.
Right. And this isn't just a casual nickname, like you said. It seems central to his argument that Powell has consistently been behind the curve on monetary policy. Can you unpack that phrase a bit? Behind the curve. What does that actually mean in this context, and why is that such a stinging accusation?
It really is a stinging accusation. Behind the curve is a classic central banking phrase, and it implies a fundamental failure in judgment or perhaps foresight.
Okay.
In Trump's view, and generally in economics, it means the Fed is perceived as being reactive rather than proactive.
Yeah.
Always catching up to economic trends instead of anticipating them.
So like closing the barn door after the horse is bolted.
Kind of, yeah. If the Fed is too slow to cut rates, as Trump alleges here, it could mean unnecessarily stifling economic growth.
Okay.
Think of it like this. If the economy is already slowing down and the Fed keeps rates high, it's like keeping a heavy foot on the brake when you should maybe be easing up on the gas.
Right.
And that could lead to lower GDP growth, fewer job creations, reduced business investment, things like that.
And the flip side, can they be behind the curve the other way?
Absolutely. If the Fed is behind the curve on inflation, meaning they cut rates too soon or don't raise them fast enough when prices are surging, then inflation could become entrenched.
Which is harder to fix later.
Much harder. It might require even more painful measures to bring it down later, potentially even triggering a recession. So Trump's argument here is that Powell's perceived delay, this too late factor, has cost the economy. He used the term incalculable potential.
Wow.
Yeah, limiting its full capacity for expansion and ultimately, he argues, harming the financial well-being of Americans.
It's interesting, though, because despite all this criticism, Trump also asserts this kind of economic optimism from his point of view.
Right.
He stated that the economy is so good that we've blown through Powell and the complacent board. That's a direct quote.
Yeah, I saw that.
It's almost like he's saying, look, despite Powell's mismanagement, the economy is actually thriving because of other factors.
Yeah.
Maybe my
They're
factors.
trying to have it both ways.
Yeah. Criticize the Fed, but still claim economic success.
That's a key part of his narrative, and you have to admit, it's a clever political maneuver. Well, he's painting this picture where the underlying strength of the economy, perhaps, as you said, due to his previous policies, or just inherent American resilience, is so robust that it's actually overcoming what he views as the Fed's hindrance.
Okay.
He frames himself as the architect of an economy so powerful it can, quote, blow through what he sees as bureaucratic resistance or incompetence.
And we should probably remember the history here too, right? President Trump himself appointed Jerome Powell back in 2017.
That's a crucial piece of context, absolutely. It adds another layer to this whole dynamic. Because it's a departure from the usual presidential Fed chair relationship. Typically, there's a more hands-off approach from the White House, at least publicly, precisely to preserve that sense of central bank independence.
Right, arm's length.
Exactly. So this is a very public breaking of ranks with someone he chose for the job. It's quite traumatic.
Okay, so that's Trump's side of the argument. The calls for immediate cuts, the sharp criticism of Powell's timing, the too late moniker. Now let's flip the coin. Let's look at the Federal Reserve's stance and the economic reality they've actually been navigating.
Right. What's the view from inside the Eccles building?
Yeah. What's the current state of play with interest rates and inflation from their perspective, and why has the Fed been so cautious, seemingly?
Okay, so the Federal Reserve has held its benchmark interest rate range steady. It's between 4.25% and 4.5%. And it's been there since December 2024.
So quite a while now.
A prolonged period of stability, yeah. Especially at a relatively high level compared to the, near zero rates we saw for many, many years before that.
True.
And when we look at inflation, the latest data we have for July shows it was at 2.7%.
Okay, 2.7, which is down, but
Significantly down from the peaks, absolutely. I mean, remember, we saw inflation spike well over 9% at its worst point.
much painful.
But 2.7% is still notably above the Fed's long-term target of 2%.
And that 2% target isn't just pulled out of thin air, right?
No, not at all. It's widely considered the sweet spot for sustainable economic growth without the corrosive effects of consistently rising prices. So this 2.7% figure, it really shows the tightrope they're walking.
Progress, but not quite there yet.
Exactly. Progress has definitely been made, but the job isn't quite finished in their eyes.
Right. And it's important for you listening to understand that this isn't just Jerome Powell making these decisions unilaterally in some back room, right? Despite how the president's personal attacks might make it sound.
That's a really common misconception, and it's vital to clarify.
How does it actually work? Who makes these calls?
Interest rate policy is determined collectively by the 12-member Federal Open Market Committee, the FOMC.
Okay.
This committee includes the 7 governors of the Federal Reserve Board, the president of the Federal Reserve Bank of New York, that's always a permanent voting member, and then presidents of 4 other regional Federal Reserve banks, and those spots rotate annually.
So, a group decision.
Very much so. Each member, including Chair Powell, gets 1 vote. So while Powell leads the committee, he chairs the meetings, he steers the discussion, the actual decisions are the result of a consensus or a majority vote among this diverse group of economists and policymakers.
The deliberative process.
Absolutely. It involves extensive analysis of economic data, forecasts, different economic philosophies even. The debates within the FOMC, from what we understand, can be quite robust. It's not a rubber stamp for the chair.
Okay. So, given that inflation is still above target, 2.7%, and given this whole group decision-making process, What's the Fed's rationale for holding steady for so long, even with all this external pressure, particularly from Trump?
Right. What are the complex factors they're weighing?
Yeah.
Why the caution?
Well, their hesitation has been multifaceted, really deeply rooted in their dual mandate:
Which is?
achieving price stability, getting inflation back to that 2% target, and achieving maximum employment, making sure as many people who want jobs can find them without overheating the economy.
Okay, so dual goals. Dual goals. And initially, a strong labor market was a primary reason for caution. Before these recent data revisions we'll talk about, the employment numbers looked really robust.
Right. Low unemployment, wage growth.
Exactly. Which typically gives the Fed less urgency to cut rates because the economy doesn't seem to need immediate stimulus.
Makes sense.
They also express significant concerns about, and this is a quote, a renewed round of tariff-driven inflation.
Trade wars potentially creeping back in.
That's the worry. The potential for new trade disputes,
Yeah.
the imposition of import taxes, tariffs, those can drive up the cost of imported goods, and that ripples through the economy, pushing up domestic prices too.
Another inflation shock.
Exactly, an external shock they have to factor in. So the overriding fear for the Fed for months has been that cutting rates too soon could doubly accelerate inflation,
Doubly accelerate.
meaning it could undo all their hard work to bring it down and potentially kickstart a new upward spiral.
Oh.
They worried about that feedback loop, Rising prices lead to higher wage demands, businesses pass those costs on, leads to more price increases, and so on. This concern about a potential inflationary spiral really kept them very cautious. Priority number one was getting inflation firmly back towards 2%.
But now things have shifted a bit. We've seen some new data recently that seems to be changing expectations, at least in the markets.
Absolutely. This is where the narrative really starts to pivot.
Tell us about these revisions to the jobs numbers and the latest inflation reading. How's that impacting what people expect for the next Fed meeting?
Yeah, this was pretty significant. We saw a major downward revision to employment data.
Yeah.
It revealed that a staggering 258,000 fewer jobs were added since May than was previously reported.
Wow, that's a big revision.
That's a huge downgrade.
Yeah.
It suggests the labor market might not have been quite as robust, quite as tight as initially thought.
Okay.
Alongside that, the July inflation reading, while still at 2.7%, held steady. It didn't rise, but it didn't fall significantly either.
So softer jobs, steady-ish inflation.
Exactly. And that combination, the softening labor market data, which maybe indicates less potential for wage-driven inflation, plus stable, albeit still slightly elevated, inflation has now led to what the source is calling a widely expected quarter-point rate cut at the next FOMC meeting.
Which is when?
That's scheduled for September 17th.
Okay, so the market's kind of pricing that in already.
Very much so. Bond yields, futures contracts, they're all adjusting based on the high probability the market sees of such a move in September.
Okay, so while a cut is now anticipated by the market for September, Trump's calls for an immediate cut or some kind of emergency reduction. That still seems out of sync with how the Fed usually operates, right? Especially now.
Way out of sync.
Has the Fed even done emergency cuts recently? How likely is that now, given this new data?
Emergency intermediate rate cuts are exceedingly rare. They're typically reserved for moments of severe systemic economic crisis. Well, the last time the Fed took such a drastic step was during the early days of the COVID-19 pandemic, March 2020.
Right, when everything was shutting down.
Exactly. The stock market was in free fall. Global supply chains just ground to a halt. The economy faced this unprecedented shutdown. That's an emergency. Before that, you'd have to look back to the 2008 financial crisis.
Okay, so major crises only.
These are not routine policy adjustments. They are crisis interventions. And as Joel Berner, the senior economist at Realtor.com, put it, Powell and the Federal Reserve broadly seem committed to the central bank's political independence, which makes an emergency intermediate rate cut seem unlikely.
Why is that independence piece so key here?
Because the Fed is committed to its established process. They meet regularly, they analyze data, they deliberate, acting on an emergency basis now, when a scheduled meeting is just weeks away and the data, while softer, doesn't point to an immediate systemic collapse. Well, it would essentially look like bowing to political pressure.
Which they desperately want to avoid.
Extremely keen to avoid, especially under this kind of intense public scrutiny. It undermines their credibility.
It really does sound like a high-stakes political chess match playing out in public. You've got the president making these very specific demands. How do experts view this dynamic, particularly for President Trump, when he's basically trying to push the Fed into a corner like this?
Well, TD Cowen's Jarrett Seiberg offers a fascinating perspective here. He suggests that the situation, maybe paradoxically, politically benefits Trump, almost regardless of the outcome.
How does that work?
It creates this scenario where if there's any economic weakness, say GDP slows down, unemployment ticks up, he can readily blame Powell and the Fed. He can say, see, I told you. They were too late, or they stifled growth with these high rates.
So he can blame them if things go bad.
Right. He frames himself as the one who saw the problem coming. But at the same time, if inflation continues to decline and the economy actually stays strong, he can still claim credit.
How?
By arguing, like he did, that the economy blew through Powell on the complacent board, that his economic vision, his policies were so powerful they overcame even the Fed's perceived errors.
So from a political strategy standpoint,
he positions himself to win either way, at least in the public narrative he's trying to craft.
that's quite the strategy. It almost sounds like a political heads I win, tails you lose scenario for him regarding the Fed.
It has elements of that, yeah.
But beyond the immediate political gain, what does this dynamic where a president is effectively, weaponizing a central bank's actions or independence, what does it tell us about the evolving landscape? Are we seeing a fundamental shift here?
That's a really crucial question.
And does this constant pressure actually affect Powell's decisions? Does it make him more or less likely to cut rates, do you think?
You've hit on a critical point about how these dynamics might be evolving. It certainly signifies a more direct, publicly confrontational approach from the executive branch towards what's supposed to be an independent institution.
Right. Usually it's more behind the scenes.
Historically, yes. Presidents tended to voice preferences more subtly, maybe through advisors or in private meetings, precisely to avoid that perception of political interference. Trump's approach is just a stark departure. It could set a precedent, maybe embolden future presidents to exert similar public pressure.
Which challenges that economy.
Directly challenges the long-held norm of central bank autonomy.
Yeah.
Now, as for its effect on Powell specifically, Seiberg, the analyst we mentioned, he actually believes Trump's pressure may even harden Powell's resistance to cutting rates.
Really? Make him less likely to cut?
Potentially, yes. Because doing so, especially an emergency cut or right after a demand, could appear to be bowing to political pressure.
And that's the worst-case scenario for the Fed's credibility.
Absolutely. The Fed places an exceptionally high value on its perceived independence. If Powell were to cut rates immediately following a presidential demand, it could severely undermine that independence in the eyes of the public and maybe more importantly in the eyes of global financial markets.
Why do the markets care so much?
Because perception matters immensely. The Fed's credibility is what allows its policy decisions to actually be effective. If markets or, international partners start believing the Fed is politically motivated, it could lead to all sorts of negative consequences, like volatility, capital flight, maybe a loss of confidence in the U.S. financial system, which could have far larger negative implications for the Fed's credibility and even the stability of the dollar long term.
Wow. Okay. And it seems the president isn't just criticizing Powell. He's also extending that criticism to the people who recommended Powell for the job in the first place.
Yeah, he's taken aim at his own former Treasury Secretary, Steven Mnuchin.
Referring to him as?
Steve Mnuchin. And suggesting Mnuchin had given him a beauty, kind of sarcastically, obviously, when he pushed for Powell's appointment back then.
So very personal finger-pointing, spreading the blame.
Yes, it's definitely part of a broader narrative of finding fault with the current leadership and the decisions that led to their appointment. It kind of diffuses responsibility for any perceived economic shortcomings.
And this all feeds into a larger discussion about who gets appointed to the Fed, right? Especially thinking about future appointments.
Exactly. And on that note, Trump has also recently nominated Stephen Miron, who's the current Council of Economic Advisors chair, to the Fed board.
Okay. And what's his background or stance?
Well, Miron holds some interesting views. One thing mentioned is his preference for expanding voting rights on the FOMC to all the regional Fed bank presidents, instead of the current rotating system for most of them.
What would that do?
Potentially, it could foster broader debate, maybe bring more diverse regional viewpoints consistently into the decision-making process.
But would it fundamentally change things?
Probably not, fundamentally.
Yeah.
As Seiberg notes, even if Miron is confirmed, he's still just one vote among many.
Right.
He's unlikely to fundamentally shift the FOMC's core focus, which, remember, remains that dual mandate: price stability, aiming for 2% inflation, and maximum employment.
And maximum employment isn't just zero unemployment, right?
No, exactly. It's not a fixed number. It's generally understood as the lowest level of unemployment that the economy can sustain without igniting significant inflationary pressures. It's about ensuring that as many people as possible who want to work can find jobs, but in a way that doesn't overheat the economy and cause inflation to take off again.
A tricky balance.
A very tricky balance, and often the source of much debate within the Fed itself. But that dual mandate, those two goals, they remain the unwavering North Star for the FOMC.
Okay, so just to summarize this first big battleground, it's a fundamental disagreement over the pace and timing of monetary policy, right? But it's deeply intertwined with political maneuvering.
Absolutely.
And you've got the Fed walking this tightrope between managing the economy based on their mandate and the data and trying desperately to preserve their independence from political pressure.
It's a complex mix, no doubt. Economic realities clashing with high-stakes political strategy, with the Fed constantly balancing its goals against this really unprecedented level of public pressure.
Okay. But just when you think you've kind of grasped the full scope of that clash, another front has opened up. A quite surprising one, really.
Yeah, this one came a bit out of left field.
It adds an entirely new dimension. This massive controversy surrounding the Federal Reserve headquarters renovation and President Trump's threat of a multi-billion-dollar lawsuit.
It absolutely does. This is a very unusual development. We've moved beyond policy disputes now into allegations of operational mismanagement and potential legal action.
So what's the central allegation here? What's Trump claiming?
His claim is staggering, really. He alleges that somewhere between $3 billion and $3.1 billion was spent on Federal Reserve building work that, in his estimation, should have cost only $50 million.
$50 million compared to $3 billion.
Or maybe he also said $50 to $100 million. But still, a massive discrepancy. He described the work itself as a horrible and grossly incompetent job, clearly implying gross waste and mismanagement under Powell's watch.
And this isn't just him complaining on social media, is it? He's actually threatened legal action.
He has. He stated he is, quote, considering allowing a major lawsuit against Powell to proceed related to this alleged mismanagement.
Okay. Considering allowing it to proceed, what's the status of this potential lawsuit? Do we know anything more? How serious is this threat?
Well, the exact nature of this threatened lawsuit remains unclear, according to our sources.
So nobody knows what form it would take?
Not really. We know that a Fed spokesperson, when asked by reporters, declined to comment on the matter. That's pretty standard for the Fed regarding political statements.
Right.
And the White House press secretary, Caroline Leavitt, she deferred to the president, basically saying she'd leave it to him to comment further on it.
Okay, so not much clarity there. But the threat itself is significant.
What's important here, as the sources point out, is that this threat marks a shift in tactics for Trump.
How so?
Well, for months before this, he'd been making these direct threats to just fire the Fed chair.
Right, which experts said was legally questionable.
Highly questionable. Most experts deemed it legally dubious and potentially incredibly destabilizing. A Fed chair is appointed for a fixed term, 4 years, and can generally only be removed for cause.
And cause doesn't usually mean disagreeing on interest rates?
Exactly. It typically means things like dereliction of duty, malfeasance, not policy disagreements.
Yeah.
So a lawsuit, while still highly unusual and potentially baseless, represents a different kind of pressure. It's like using a legal cudgel rather than a direct removal threat.
Okay, so before we get into the legal side or the politics of it, let's just understand the renovation project itself. What buildings are we actually talking about here?
Right.
And what kind of work is being done that could possibly justify costs in the billions, even if not $3 billion? What's the backstory?
Okay, so we're talking about two pretty iconic and historic buildings right there in Washington, D.C.
Which ones?
The main one is the Mariner S. Eccles Federal Reserve Building.
Yeah.
Beautiful building. And then there's the adjacent 1951 Constitution Avenue structure, which they call the FRB East Building.
And they're old.
Very. Both were originally constructed back in the 1930s. So we're discussing structures that are nearly a century old now.
Wow.
Built with technologies, materials, systems that are just long outdated. And in some cases, actually hazardous by today's standards.
Okay. And the scope of the work, it's not just like a facelift or new carpets, is it? When you say historic, that often implies some unique challenges.
Oh, far from it. The renovations are described in the source material specifically as necessary structural updates, and they emphasize not luxuries.
Okay. Necessary. Like what?
This means the work is addressing fundamental issues, things essential for safety, for functionality, for meeting modern standards. We're talking about extensive work like asbestos removal.
Ugh. Yeah, that's always complicated and expensive.
Incredibly complex, hazardous, and costly, especially in large old buildings where asbestos was just used everywhere. Insulation, fireproofing, floor tiles.
Right. What else?
There's also major structural work to meet modern safety standards. Think about things like earthquake retrofitting, ensuring the buildings can withstand modern stresses, complying with current building codes, which have changed dramatically since the 1930s.
Makes sense.
And crucially, it involves the replacement of antiquated systems, ventilation, plumbing, electricity, fire detection systems. Imagine a building from the 1930s trying to cope with the electrical load of today's data centers, servers, computers everywhere.
Yeah, the wiring probably wasn't designed for that.
Not even close.
Mm.
Or plumbing that's nearing the end of its lifespan, potentially leading to leaks and damage. The key point here, and the Fed emphasizes this, is that neither building had seen a comprehensive renovation since they were first constructed, almost 100 years ago.
So long overdue, essentially.
Long overdue. These are foundational safety-related projects for aging, but still critical infrastructure. You can't just, slap a new facade on a building that has failing pipes and dangerous electrical systems inside.
Okay, that definitely puts the need for some major work into context. But the costs still seem to have ballooned quite a bit, even from the initial estimates, right? Can you walk us through that financial trajectory?
Yes, the costs have definitely increased.
From the original projection to Trump's, $3 billion figure, what caused these increases, according to the Fed?
Certainly. So the project was originally estimated at $1.9 billion.
Okay, already a big number.
Already a very significant number. However, that figure has now climbed to an estimated $2.5 billion. And President Trump, as you mentioned, is citing figures even higher, up to $3.1 billion.
Right. So why the jump from 1.9 to at least 2.5 billion?
The reasons provided by the Fed for these cost increases are actually not that uncommon for large, complex infrastructure projects, especially involving historic buildings and hazardous materials.
Like what?
They've cited multiple delays. Delays themselves cost money. And part of that was rising materials costs. I mean, we've seen that across the entire construction industry in recent years, right?
Yeah.
Supply chain issues, inflation hitting materials hard. Then there's the aforementioned asbestos remediation. Often, when you start opening up walls in old buildings, you find the problem is more extensive than initially thought. That increases the scope and the cost significantly.
Unforeseen complications.
Exactly. And in a rather unique twist for this project, there was apparently even a sinkhole on the project site.
A sinkhole? Seriously?
Seriously, which would require unexpected geotechnical work to stabilize the ground before you can continue building safely. That's definitely not in the initial budget.
No kidding.
So these are the kinds of unforeseen real-world issues that can significantly impact project budgets and timelines. They lead to cost overruns that, while large, aren't necessarily indicative of mismanagement, just the complex reality of such a project.
Okay, so how has Powell and the Fed defended these costs? How have they justified the necessity of such an expensive project, especially to the Trump administration and now publicly?
Chair Powell has been quite clear and direct in his defense. In a letter he sent to the Trump administration back on July 17th, he stated, quote, "Both buildings were in need of significant structural repairs and other updates to make the buildings safe, healthy, and effective places to work."
Emphasizing the necessity.
Exactly. He emphasized these were not discretionary upgrades, not luxuries, but absolutely essential for the well-being of the thousands of employees who work there, and also for the continued secure operations of a vital national institution. You need the building to function reliably.
Did he mention oversight?
Yes, he also noted that the renovations are in full compliance with plans approved by the National Capital Planning Commission back in 2021. This indicates the project has gone through the appropriate regulatory oversight and approval processes.
Okay. And wasn't there a tour? Didn't Trump see the site?
Yes, that's also worth noting. Powell and Trump actually toured the renovation site together just last month. So this visual, direct interaction on the issue suggests that Trump had at least some firsthand exposure to the scale and the nature of the work being done, even if he still chooses to publicly criticize his costs so strongly now.
Interesting. Okay, so given all that, the age of the buildings, the necessary work, the unforeseen issues, the official approvals, how do experts in the field view this lawsuit threat from Trump? Is it seen as legitimate, a serious legal challenge, or something else?
Well, Joel Berner, the Realtor.com economist we heard from earlier, his view is pretty blunt. He thinks the threatened lawsuit seems more like political mud-throwing than anything substantive.
Political mud throwing.
Yeah, he interprets it less as a genuine legal pursuit and more as just another pressure tactic.
How so?
He explains that it seems intended to put pressure on Powell from a different angle rather than using direct threats at his post.
Because threatening to fire him is legally tricky and destabilizing.
Exactly. As we discussed, direct threats to remove the Fed chair, especially without very clear cause, could have a disastrous, destabilizing effect on the economy and the standing of the Fed in the global financial system. The legal grounds for suing a sitting Fed chair over operational costs, especially when those costs have been approved by relevant planning commissions and for necessary structural work on century-old buildings,
Yeah.
well, they seem highly questionable, legally speaking.
So it's less about the actual legal merit of a potential case and maybe more about exerting influence, keeping Powell on the defensive, maybe a public relations battle.
Exactly that. It seems like a way to keep Powell on the defensive, keep him in the public eye for something other than just monetary policy. It helps create a narrative of fiscal irresponsibility, even if the facts of the renovation are, much more complex.
Divert attention, maybe?
Perhaps. It's a tactic to maintain pressure, but from a different angle, rather than directly challenging his authority to set interest rates.
Yeah.
However, going back to Jarrett Seiberg from TD Cowen, he noted, and this applies here too, that this kind of thing, whether it's rate criticism or a lawsuit threat, is ultimately unlikely to influence Powell's approach to monetary policy.
Why not? Wouldn't you feel the heat?
Because the Fed operates based on its mandate price stability, maximum employment. And these external pressures, while politically significant and probably personally unpleasant for Powell, don't typically sway the committee's core economic decisions, precisely because they are so fiercely committed to maintaining that independence and appearing objective.
It's truly fascinating how these two really distinct issues, the immediate economic impact of interest rates on one hand, and this highly technical long-term issue of building renovations on the other, are both being leveraged in this very public confrontation.
It really is striking.
This brings us, I think, to the broader stakes of this entire saga. Beyond the specific battles over rates and renovation costs, what's the fundamental concern? What are economic observers and market participants really worried about when a president so openly and repeatedly challenges the Federal Reserve like this?
The core concern, and it's a very serious one with potentially global implications, is that President Trump is perceived as attempting to undermine the independence of the central bank.
Undermine independence. Why is that so critical?
It's about potentially bringing the Fed into closer alignment with his short-term political priorities.
Yeah.
This isn't just about a president disagreeing with a specific policy decision. It's about potentially eroding the institutional safeguards that allow the Fed to make decisions based solely on objective economic data and analysis, free from the pressures of election cycles or immediate political gain.
And a politically compromised central bank is bad because
It can lead to disastrous economic outcomes down the road. Think about it. Governments might pressure the Fed to keep rates artificially low to finance spending sprees, which could lead to runaway inflation. Or they might pressure them to avoid necessary tightening before an election, leading to unsustainable booms followed by much deeper busts later.
undermines confidence too, right?
Massively. It undermines investor confidence, both here and abroad. It raises borrowing costs for everyone, governments, businesses, individuals, and it could severely damage the U.S. dollar's standing as the world's primary reserve currency. That independence is seen as a cornerstone of U.S. economic stability.
And how has Powell himself responded to this persistent pressure? Especially the calls for him to just step down or to expedite rate cuts. You'd think it might be easier just to give in rather than endure this constant public criticism.
He really hasn't given in. Powell's maintained a remarkably steadfast stance, demonstrating, I think, a strong commitment to the institution's independence.
How so?
Sources indicate his continued commitment to completing his current term as chair, which is set to expire in May 2026.
So he's planning to stick it out.
That's the message. He has made it clear, both implicitly through his actions, like holding rates steady despite pressure, and in past public statements, that he intends to operate in the best interests of the American economy, despite Trump's constant calls for him to step down or to expedite rate cutting.
And that commitment itself is important.
Absolutely crucial. Sticking to his full term and his mandate is vital for maintaining the institution's perceived independence and credibility, both here at home and internationally. It sends a really strong signal that the Fed aims to stay above the political fray.
Okay. But what if that independence were compromised? What are the potential consequences if, hypothetically, a president were successful in removing a Fed chair before their term expires without legitimate cause? Or if Powell were to resign under this kind of pressure?
The warnings from experts are pretty clear and pretty dire. Attempting to remove Powell before his term expires, or even the perception that he resigned due to political duress, could destabilize markets and raise mortgage rates.
Destabilize markets? How?
Because the credibility and independence of the Fed are just paramount to financial market stability. If investors, both here and overseas, perceive that the U.S. central bank is no longer truly independent, they lose confidence in the predictability and stability of U.S. monetary policy.
And that loss of confidence leads to?
It can lead to a rapid sell-off in U.S. assets, stocks, bonds, a decline in the dollar's value, and higher borrowing costs across the board because lenders demand a higher risk premium.
So for you, the listener, this isn't just some abstract concept.
Not at all. It means potentially higher mortgage rates, yes, but also higher rates on your auto loans, your credit cards, business loans, all of which would slow down economic activity. It would be seen globally as a fundamental undermining of a cornerstone of financial stability.
So this really isn't just high-level economic theory then. It has very real connections to everyday life, particularly when we talk about things like mortgage rates.
Absolutely.
Can you draw that line clearly? How does the Fed's interest rate policy and this whole political dance surrounding it affect something as tangible as your mortgage or your ability to finance buying a home?
That's a critical, tangible link for millions of people. The Fed's benchmark interest rate, the federal funds rate, it directly influences a wide range of short-term borrowing costs. But its expected future path also deeply impacts longer-term rates, like those for 30-year mortgages.
How does that work?
For instance, we've seen 30-year mortgage rates, as the sources note, remain kind of stuck in this narrow range above 6.6% since December 2024. That's not just a number. It translates to thousands of dollars in extra interest over the life of a loan for homebuyers compared to lower rates.
Right.
Now, they did recently see a slight decline, down to 6.63%, which was the lowest since April. But significantly, that followed those downward revisions in employment data we talked about.
The data that made a September cut seem more likely.
Exactly. Lenders anticipate the Fed's moves. Those anticipations get priced into the market today. When the market starts seeing a higher probability of future Fed rate cuts, mortgage rates tend to ease a bit, even before the Fed actually acts.
And the reverse is true, too.
Absolutely. If the market starts fearing higher inflation down the road, or maybe unexpected Fed tightening because of political pressure or new data, mortgage rates can go right back up, even if the Fed hasn't moved yet.
So essentially, when the Fed signals it might ease rates, or the data suggests they might, the markets react almost instantly. And that can trickle down pretty quickly to something like your potential mortgage payment or the cost of financing a car.
Precisely. The market is always trying to anticipate the Fed's next move. So future easing for mortgage rates, as Realtor.com points out, will really hinge on whether market players believe inflation is truly under control and likely to stay that way.
So confidence is key.
Confidence is absolutely key. If there are signs of resurgent inflation, or if confidence in the Fed's independence wavers, market sentiment alone could send mortgage rates higher again, because lenders would demand a higher return to compensate for that perceived risk or future inflation.
So these high-level clashes, the Fed's delicate balancing act, even the president's pronouncements on social media, they have direct implications for anyone looking to buy a home, refinance, take out a business loan, or even just manage their credit card debt.
It really affects your borrowing costs, your ability to make significant financial decisions, and just the overall economic climate you're operating in every single day. The confidence that the Fed will act independently and predictably is a cornerstone of a stable financial environment for everyone. And that confidence, that cornerstone, is really what's being tested here.
Looking ahead then, what's the path forward? Is this intense pressure likely to ease up, or are we probably in for more of the same, especially as we get closer to that September FOMC meeting?
Well, based on the consistent pattern of behavior we've seen, and also the political benefits that analysts like Jarrett Seiberg identified, it seems highly likely that President Trump will continue exerting pressure on Powell.
Through the usual channels?
Probably. Through social media, other public statements, maybe even at rallies, especially as that September 17th FOMC meeting approaches and we get more economic data releases between now and then.
It's become part of his platform, almost.
It really has.
Yeah.
He's made it clear this is a significant part of his public economic platform and a key point of attack against the current administration's perceived economic policies or the Fed's actions. There's really little indication he'll back down from this strategy anytime soon.
And for the Fed itself, what kind of tightrope do they continue to walk through all of this? Maintaining their mandate, navigating this relentless scrutiny.
The Fed's dilemma is profound, really. They have that dual mandate we keep coming back to. Price stability, getting to 2% inflation, and maximum employment, keeping the job market strong without overheating.
Right.
They have to pursue these goals while navigating just immense public scrutiny and, critically, trying to maintain their political independence. It's a constant balancing act.
Decisions based on data, not demands.
That's the goal. They need to make decisions based on complex economic indicators, not on political demands, in order to preserve their credibility and their effectiveness. Internally, this can create tension too, between members who might prioritize one side of the mandate slightly differently or who interpret the incoming data in different ways.
Sure.
But the overarching commitment, you have to believe, is to make those data-driven decisions that serve the long-term health of the American economy. The stakes are incredibly high, not just for the economy, but for the institution itself. Its perceived impartiality is really its most valuable asset.
And just quickly, on that other front, the renovation costs. Are there any lingering actions expected there, even if the president's specific lawsuit threat seems maybe less substantive?
Yes, it's possible we haven't heard the last of that.
Yeah.
The source material does indicate that some Republican lawmakers have already suggested they may open an investigation into the increased projected cost of the renovations.
So Congress might get involved.
It's a possibility. So while the president's threatened lawsuit remains vague and its legal standing is questionable, the whole controversy over the renovation costs could yet lead to formal inquiries from Congress. That might mean hearings, reports.
Keeping the issue alive.
Exactly. It would keep the issue alive in the public discourse and could force the Fed to provide even more detailed justifications for the project's expenses, extending the pressure beyond just presidential rhetoric into the halls of Congress.
Looking back at everything we've unpacked today, it's truly striking, isn't it, how these two seemingly really different issues, the immediate economic pressure of interest rates on one hand and the longer-term implications of managing an institution's basic infrastructure on the other are so deeply interconnected in this public clash.
It really is. It makes you realize just how many layers there often are to even what seems like straightforward headline news.
Absolutely. This deep dive, I think, has shown how even seemingly simple economic news is often deeply intertwined with political strategy, with differing interpretations of the facts, and with this really delicate balance of institutional independence.
It truly has. And this kind of public, very high-profile confrontation, it really forces us all to examine the very foundations of how our key economic institutions function, and maybe the norms that typically safeguard them.
Yeah. The tension between President Trump's, let's say, desire for immediate action and control and the Fed's commitment to its long-term mandate and its independence. It's not just political theater, is it?
Not at all.
It feels like a fundamental debate about how our economic institutions should function in the 21st century. It really prompts us to consider the whole nature of central bank independence, not just here in the U.S., but maybe globally, too.
Indeed. And I think this leads us to a really crucial question for you, our listener, to maybe ponder after we finish up here. Given this constant public pressure, and given the immense importance we've discussed of the Federal Reserve's independence, how do you think central banks can best maintain their non-political role in what seems like an increasingly politicized world?
That's a big question.
It is. And what does this specific clash, the one between President Trump and Chair Powell right now, what does it suggest about the future of these kinds of critical institutions, not just here, but potentially setting precedents, maybe, for how independent central banks are viewed and challenged around the globe in the years to come?
Definitely some food for thought there. Thank you for joining us on the deep dive.